This clip will break the first rule for stock market analysts. Either give them price or give them time, but don't give them both. Well, I'll give you both, but then make up for my sin by providing my exact reasons for the forecast. It'll be in two parts. First, where are we now? At present, the S&P 500 is at about 5,600, and we are 2.5 months before the US elections of November 5. To see where we are going, I rely on three facts. Fact number one, the Democrats are stuck with Kamala Harris, a below average candidate, because after Obama fired Biden, allegedly, Biden endorsed her. Now the press sings her praises, even though she can apparently hardly speak coherently. And why is this important? This would be fact number two, because it forces Janet Yellen, Treasury Secretary, to print T-bonds with an even greater abandon than before to help her party get reelected. But then on top, there's fact number three, that institutional investors who run OPM in the trillions, that's other people's money, their job depends on outperforming the market quarter by quarter. That is, outperforming half of all their colleagues. Or as an old client of mine once said, institutional money runners are like elephants taking in each other's laundry, jumping from lillypad to lillypad, trying to stay afloat. These OPM runners now have tons of cash in their portfolio because of their fear of a market crash, so 90% of them do worse than the market. I have several friends who are in such jobs, and they are mostly scared spitless of being fired, so they must keep buying even as the market soars, which makes the market soar even faster. In sum, the Democrats are stuck with a below-par candidate, so they must push the market up by printing even more bonds, and institutions have tons of cash, so they must be buying too. These three facts make me convinced the market will rocket here, probably to about 7,000, maybe a sneak more. Why this number? That's because of the amounts Janet Yellen prints and plans to print, as per the QRA, which is short for quarterly refinancing announcements. In the past, the QRA gave you only a ho-hum indication about the market because the Fed was the boss and Treasury obeyed, but no longer. Now that Janet Yellen rebelled about 2 years ago based on my informers, she is the boss, and the Fed must mop up what she prints. So the QRA is very telling. Their numbers, both T-bills, that's short-term bonds, and T-bonds, that's long-term, 20 and 30-year bonds, practically forecast what's coming, in my humble opinion. At any rate, I can see the S&P 500 going up a sneak above 7,000. Is there any precedent for such a fast rise? Yes, 1999, when the Nasdaq rose 150% and the Dow rose 50%. In my opinion, we'll see something similar soon, maybe not as outrageous, but close. By that time, I betcha everyone and every channel will be singing the Fed praises for having engineered a very slow economic fall, or as they call a soft landing. Okay, so that's the first part. The market will soar here for a few months, but then something will happen. That's part two, and the economy will crack. Of this, I'm equally certain. Now, why will the economy crack? I don't know the exact catalyst. Maybe a US investment bank will croak, like Lehman Brothers, or a Chinese condo builder will go bankrupt, like Evergrande. But the economic crack is for me a near certainty. But again, why a certainty? As I told you a few clips ago, it's because of the yield curve. The yield curve is the difference between the long bond rates and short rates, kind of the difference between your mortgage rate and the rate that banks pay on high deposits. When it's negative, it's because the Fed, or really the Treasury today, is stingy with money. So the economy becomes weaker and weaker. And here is the crux of it. The longer the yield curve remains negative, the weaker the economy gets. At a certain point, it becomes fragile and cracks. And then we get a recession. Or sometimes even worse, a depression. Why worse? Because today the yield curve has been negative the longest period in history. Yes, the yield curve has been negative longer than even before the Big Depression in the US of 1929. Therefore, what's coming soon after the market soars will likely be the mother of all economic downturns in our lifetime, a short depression. How sure am I of this? Fairly sure because of two facts. Fact number one, as I said, the yield curve has been negative for 689 days. So even though recently it blipped back into positive, only briefly, the damage is done. And fact number two, related to fact number one, the Fed has been taking an inordinately long time to cut interest rates. In the past, the longer it took the Fed to cut, the worse was the market decline. In sum, the economy is in historically deep doo-doo, only you don't see it fully yet. Yet, the market is likely to soar because the market now is a roadrunner running off a cliff, still staying up because it hasn't looked down yet. When will the market look down and start falling? At the pace it's going, it'll be either just before year end or very early next year, or even a little before or after the election. Again, I don't know. But somehow, I don't think it'll be before because the market is currently so scared it'll take a while to take the fear out of it and implant euphoria. Now, how far would the S&P fall? In my opinion, it would plunge to about 1,500, maybe a shade less, which is 75% or 80% lower than the top. Why so much? Do a simple chart. On the x-axis, plot the length of time the yield curve stayed negative in the past. On the y-axis, the following market plunge in percent. As you will see, there's a direct, scary correlation. The longer the yield curve has stayed negative, the deeper the ensuing market plunge. And the scariest part is the length of time today is equal to the only one time before, 1928, 1929. At that time, the market plunged 89%. I think it may be similar now. This means once the S&P scratches 7,000, it could then go down in waterfall waves until it reaches 1,500 or plus minus a little, which, by the way, is also my calculation of its fair value. And why do I think it lasts only a year versus the 3 years it did from 29 to 1933? Because the Fed and the Treasury today can do what they couldn't do in 1929. That is, print massively, which is why the decline will likely last not 3 years as then, but only a year or so now, in my opinion. At any rate, by that time next year, the unemployment in both the US and Canada will likely rise to the low teen, 11, 12, 13%, perhaps even in the mid-teen, 15, 16% or even more, as in 1982, 42 years ago. What of inflation? In my opinion, inflation will fall to zero. Yes, you heard me right, zero inflation next year. And because the economy will be half dead, short rates will go negative and long rate will fall close to 1% or maybe even less. In fact, you can glimpse some of this already since commodity prices had already been falling. Like which? How about all of it? How about all of them? Oil has been falling, is now 67, 68 bucks, down from 90 only a few months ago. It's one of the first commodities to fall because so much of it is used in the economy. Money is another commodity. Interest rates are its price. It too has been falling, as has been lumber, copper, and other commodities, which means that the Fed, when it finally cut rates, probably this month, will just be acknowledging reality, not making it. Okay, one last time. Here is the summary. The economy is cruising for a bruising, but meantime, the dissipating fear and the massive bond printing and the cash-rich OPM runners will jack the market up, up, up. Or that, at least, is my forecast. And remember, I could, of course, be wrong. Now, what actions would such a hypothetical scenario imply? It would mean one would ignore fear and stay long in the market. Then, as the market approaches S&P 6,900, ideally, to sell everything, including commodities, because they would be hit. And yes, this would mean paying the capital gain tax on your gain, which for some of the multi-baggers I've been mentioning here would be horrendous, especially in Canada. But we better be than seeing them come down even less than the market. And then on what? Why cash and US bonds or the TLT ETF? Because with rates falling close to zero, bonds will fly. And that's it? No. Then I go get a hobby and come back when the market is awash in a panic and hysteria and buy. Like what kind of hobby? How about reading? Buy my books, The Sleuth Investor and The Advanced Sleuth Investor, as well as my thrillers. So you'd have something to read while the economy craters and the market falls. And then once you read them, give them reviews on Amazon, which I hope will be good ones. Anyway, that's all for today. If you like the above, please subscribe and tell all your followers and friends to subscribe too. I'll see you next time, and meantime, thank you very much for watching.